Welcome to Freedom Numbers. By the end of this video, you're going to know your exact financial freedom targets that you're working towards. We're going to determine the real numbers that actually define what financial freedom looks like for you and your family. We're going to cover three things. First, the FIRE approach. Next, cash flow, and then determine what your freedom numbers really are. This video is part of the Cash Flow Explorer course, and we're currently in level 2, Get Your Bearings. Most people never define what financial freedom actually means for them. So you save, you invest, and you grind for decades, but you keep moving the goalpost. So we need to know that number and then know when you've actually hit it. Let's get into FIRE. This is Mr. Money Mustache, and he is widely regarded as the person who popularized the FIRE movement. For those of you who aren't familiar, FIRE stands for Financial Independence, Retire Early. And it was the first framework that gave people an understanding of when they were financially independent and when they were work optional and could retire early from their job. It is all built on a calculation called the 4% rule. And the 4% rule helps you determine when you can retire off of your investment portfolio. And you basically take a 4% every year. To visualize this, you have your investment portfolio that grows over a couple of decades, and then every year you sell off 4% of it a year to live. So when your portfolio grows large enough, you can actually live off of it. And the FIRE community has an entire culture around this math. So people optimize over it obsessively. They'll cut expenses to the bone, save 50 to 70% of their income, and invest it as much as possible. Let's dive into the 4% rule a little bit more. So you take your annual expenses, say it's $60,000 that you need to spend a year, divide it by 4, and then that is your FIRE number. And this tells you how much you need invested to cover all of your expenses. Let's show you a couple examples. So if your monthly expenses are $5,000, you need $60,000 a year in annual income to cover your annual expenses. So with a portfolio size of $1.5 million, you can sell 4% of it, and that's $60,000. Next, if you want to spend $10,000 a month or $120,000 a year, you'll need a portfolio that is $3 million. And then if you want one that's $20,000 a month or $240,000 annually, you'll need a portfolio of $6 million. Now, these aren't like perfect numbers, but in general, if you want to cut your expenses really low and retire as early as possible, that's typically called lean FIRE. A portfolio between 1.5 million to 3 million is typically regarded as regular FIRE. And then if you want to go big and have a large portfolio, that's called fat FIRE, where you have complete financial freedom and you can basically spend on whatever you want. The most important thing that the FIRE movement has taught us is that retirement isn't an age. It's actually a number. So when your portfolio reaches a certain amount, that's when you're work optional and you could technically retire. The FIRE method is really cool because it is a concrete method that you can achieve with enough discipline over time. FIRE is a completely legitimate path, but in the next concept, I want to show you a version that I like better and why. So let's get into cash flow. One thing that kind of bothers me about the FIRE movement is that you have to sell 4% of your portfolio every year. So every year you're investing a piece of your investment portfolio that you spent decades building. And you're hoping that the market cooperates. You're hoping you don't outlive your money. You're hoping there's no big geopolitical conflict. There's a lot of risk at play, in my opinion. And I believe there is a better model. Let's think about the objective. So we're trying to create $10,000 a month in income to cover $10,000 a month in expenses the rest of your life. And FIRE does this by selling 4% of your portfolio a year. But I personally didn't want to build up this big portfolio and have to sell off parts of it to live. I wanted assets that generate income that would never have to sell. So let's ask the question, how else could we achieve our goal of $10,000 a month in income? I believe it's by investing through cash flow. Now, what is cash flow? Cash flow is passive income that comes through your investments or your business. It's typically described as a monthly cash flow amount. So when I reference my $6,000 in cash flow, that is monthly passive income. But I don't love the term passive income. It really doesn't mean anything anymore. It's pretty overused. So I thought this meme was funny of Winnie the Pooh with passive income and then cash flow, with cash flow being very sophisticated. But let's move into what actually produces cash flow so that you can visualize it as soon as possible. First, you have the public markets like dividend stocks. So you have individual stocks. There are also dividend ETFs, and you have REITs, real estate investment trusts. Anybody can go out and buy these products. There's also fixed income products like bonds, high yield savings accounts, and CDs. However, these are not going to produce a very attractive yield. There's also things like real estate. So you have rentals and commercial buildings, There's lending, like private and hard money lending. There's the entire world of business. You can have ownership of an active or passive business or a franchise. There's also alternative investments like private credit, private equity, oil and gas. And then to round us out, I threw on IP, intellectual property, royalties, which is royalties from selling courses, digital products, and then also licensing your brand out to others. Let's get into a couple quick examples on passive versus active. In the case of real estate, let's look at the example of somebody buying a property in the neighborhood to rent it out. So if you are passive, you can actually give the money to somebody else who is going to go out and find the property, manage it, and then they will pay you passive cash flow back on your investment. As the investor, you need to vet the deal and vet the opportunity up front, but then after that point, you're completely passive. And if you say, well, I don't have the money to give to somebody else to do the work, well, in this case, you could be active and you can be the hustle person that goes out and you find the property and you manage it. You can raise capital from investors and then pay them back. And you can do this exact same thing for small businesses. If you're a passive investor and somebody who is buying or growing a small business, you vet the deal up front, you give them money, and then you get a good return on your investment. If you want to go out and be the person to buy a business or grow your business, that's where you would raise the money and then pay your investors back over time. When I refer to cash flow, I'm talking about investment passive income. So there's tons of people online who sell courses on how to buy real estate and buy small businesses. That is a huge topic that I'm not going to touch. It's why you hear everybody talking about small businesses and saying that the greatest wealth transfer in history is coming. There's a lot of baby boomers who are retiring and they need to sell their businesses. So a lot of young people are actually going out and buying their businesses. And to do this, they need to raise capital from investors to do so. I have way too much going on that I cannot be buying my own real estate or buying my own business. So I would rather be a passive investor and invest with the best people into the best assets as possible. So whenever I talk about cash flow investing, I'm talking about investing with others passively. So in both of these cases, you put money in and you get a great return. But if you don't have the money to invest, you probably need to put in the hustle to get your cash flow. Either way, if you want to be passive or active, there's a method that works for everybody. But when I talk about cash flow, it is passive. And this is the model I want you to carry through the rest of the Cash Flow Explorer course. Financial freedom is not a net worth number. It is just a monthly income equation. When your cash flow is greater than your expenses, that's where you're financially free. Said differently, if your monthly passive income is greater than your monthly expenses, that's financial freedom. So this is it, guys. This is the course. We're going to be spending the rest of our time talking about how we can get our cash flow greater than our expenses. This is independence and this is freedom. To show you what this looks like, this is the data from my personal portfolio that I was publishing. So in July 2025, our total cash flow was $6,642. And then in November, it was $4,601. In both of those cases, all of our fixed expenses are covered. So we didn't have to pay our mortgage, utilities, phone bills, all that stuff was paid for. And that gives you so much financial flexibility. And for all of this cash flow that you see here, I didn't have to sell anything. So the principal continues to grow and the asset keeps compounding. So the passive income keeps flowing and it is a perpetual machine, not a depletion strategy. I think this is really important to show that this is what real life cash flow looks like. And yes, I have a good bit coming from private money lending and from some other really interesting investments, but you will find your own investment mix that works best for you. I'm here to show you all of the options and then you can choose what the best fit is for you. If you want to see my real current cash flow, I actually publish it every month in my monthly newsletter. I only send one newsletter a month to not spam your inbox, and I lay everything out extremely transparently. That way you can see what I'm actually doing to generate income from my portfolio. So here's 3 examples of cash flow that I've actually done. The first is through dividend stocks. You can buy dividend stocks that pay quarterly dividends. And there's also dividend ETFs that pay out a monthly dividend. There's also things like investment real estate. If you're the landlord of a single family house, renters will pay you to use that house and maybe you get $200 a month in cash flow. And then on a bigger scale, I'm a passive investor in a 10-unit apartment building. So this is a small apartment building that can also have quarterly or monthly checks. When you slowly start to stack up these assets one at a time, you see dividend stocks pays you $100 a month, your rental can pay you $200 a month, and then the apartment building can pay you $500 a month. So what I want you to do is write out all of your different expenses. So write out your bills from smallest to largest. So you got Netflix, your gym membership, your insurance for your car and gas, and then your food budget and your housing budget. Well, when you invest and you get those dividend stocks at $100 a month, you have now used that cash flow to pay your first two bills. And now you never really have to pay your Netflix or your gym membership out of pocket again because now your dividends pay it for you. Next, let's use your rental. If your rental pays you $200 a month, you have now covered your transportation costs with your investments as well. And then with that small apartment building, you completely cover your food budget for the month. So this is the power of cash flow. You can use it to actually pay your bills today, not 20 years from now. So the goal of cash flow is to invest for passive income, and you can use that cash flow to reinvest to make the machine bigger, or you can live off of it to pay for your expenses. And when you're looking at investments, you can invest for 8% in annual passive income. So when you chart this out on the graph, you get 8% in passive income or cash flow every year, but you can break this up monthly as well. And you can actually live off of this cash flow in the meantime. So the math also looks a little bit different for cash flow. You're going to take your same annual expenses, but you're going to divide it by 0.08, and that is your annual cash flow number to see how much of a cash flow portfolio that you need. We'll take the exact same numbers from the FIRE example. So if your monthly expenses are $5,000 or $60,000 annually, you will need $750,000 invested into cash flowing investments, and then you're covered. If your monthly expenses are $10,000 or your annual expenses at $120,000, you'll need a portfolio of $1.5 million. And then if you want to go big with $20,000 a month in spending or $240,000 annually, you'll need a cash flow portfolio of $3 million. So I wanted to plot these side by side and go through the pros and cons of each. So with FIRE, you're going to build that portfolio and withdraw 4% of it a year. The pros is that it is simple. You can leave this on autopilot. You really can't mess up. There's also some really favorable tax treatment here, so there's less tax drag. If you're investing for cash flow, you need to be aware of taxes. Some of the cons of the FIRE method is that it takes 10 to 30 years roughly, and it relies on a lot of financial restriction. So you want to cut your expenses as low as possible, and you have to be careful to not run out of money. Another thing I don't love about FIRE is that it only relies on the public stock market, which is quite volatile. Moving over to cash flow, we're striving to create a portfolio with 8 to 10% in annual cash flow. The pros is that it can be a little bit quicker at 5 to 20 years. However, 20 years is still a long time, so this is not a get-rich-quick scheme. Another pro is that it actually pays your bills, so it pays your monthly expenses. You are also more diversified across other asset classes outside of the stock market, and you never have to sell your portfolio in the future. But the con of cash flowing investing in general is that it takes a lot more education and skill. You need to be much more careful and intentional in this space. You are also going to be running into more taxes through cash flowing investing, so you need to be very strategic on how you approach that. To sum it up, FIRE is a great place to start as you build your knowledge, skills, and network. You can always invest a small amount into the stock market and let that compound over time, and it'll take really good care of you. On the other hand, mastering the cash flow game will bring you so much financial abundance. But one important thing before we move on, this is not all or nothing. The FIRE approach and the cash flow approach are not enemies. The most powerful version of your financial life probably has both running at the same time. So let's think about a hybrid approach where you still build that nest egg, you max out your retirement accounts, and you use index funds. You let your compounding do its work over 20 to 30 years, but alongside that, you're also building cash flow, even if it starts really small. Creating $10,000 a month in cash flow sounds impossible, right? Well, let's actually start by lowering our expectations, because folks save every penny and commit to FIRE for 20 years. So cash flow isn't get rich quick either. Instead, I want you to think about what would happen if you could generate $1,000 or $2,000 a month in cash flow. When you can create some cash flow, you dramatically reduce how much you need in a FIRE portfolio. Let's jump into a couple examples. So if you're able to create $1,000 a month in cash flow, now part of your expenses are covered and you've also reduced how much you need in your FIRE portfolio. So your FIRE portfolio was $3 million and now it's down to 2.7. If you invest $300,000 for $2,000 in monthly cash flow, that means you've also reduced your FIRE portfolio by $600,000. So in this case, you need a cash flow portfolio of $300,000 and a FIRE portfolio of $2.4 million. And then if you're able to generate $5,000 a month in cash flow, which is awesome, you can do that with a portfolio size of $1.2 million, and your FIRE number drops to $1.5 million. So this is not an all or nothing approach. And remember, you can generate cash flow passively as an investor. So that's where we're talking about your cash flow portfolio size. But you can also go out and generate cash flow actively by buying your own real estate or small businesses. Whatever method that you choose to pursue cash flow is going to drastically reduce the amount that you need invested in long-term index funds, like through the FIRE method. These graphs also show cash flow as a flat number. However, when you invest in cash flow assets like real estate, you're getting that 8% passive income as well as the appreciation on that property. So you're getting that compound interest and the cash flow at the same time. Another myth is that you don't need $50,000 lying around for your very first cash flowing investment. Both the FIRE and cash flow methods allow you to start with small numbers that compound over time. Now let's talk about the taxes of cash flowing investments because this is very important. Cash flow investments are generally less tax efficient than long-term hold investments. They have different tax treatments. But if you don't need that passive income today, I recommend investing for growth for the longer term. Later, you can turn on the cash flow machine whenever you need it. So you can see this growth is more tax efficient at long-term capital gains rates, while cash flow can be more tax inefficient. So it may not make sense to invest for cash flow at the very beginning of your journey. Instead, when you're starting out, you can invest for growth and let that money compound. And then later, you can transform a portion of your portfolio into cash flow investments. It all depends on your income and tax treatment, but investing this way can actually help you get out ahead. Overall, taxes are the biggest threat to cash flow investing, so there's a tipping point where you move from growth to cash flow. To review our cash flow section, many cash flow investments are actually not in the stock market, and these are called alternative investments. So that's anything outside of the stock market. And you may have been hearing more about alternative investments recently. I took these screenshots from Google Trends, but you can see interest over time for alternative investments is really going up, and I believe we're still extremely early. To give you some more insight too, when people search for alternative investments, other things were best alternative investments, what are they, the market for them, private equity, funds, real estate. So you can see everything that is kind of encapsulated in this bubble. I truly believe that we're entering a new era of investing. It's not just going to be index fund and chill for the next 30 years. People want their money to be working for them now, not decades later. But I will say, beware of passive income promises and get rich quick schemes. If it's too good to be true as an investment, it probably is. And cash flow is still a long-term game. We want to be investing in really solid assets that pay you cash flow that continue to grow. And just to reiterate, the cons of cash flow is that it takes more education and skill. It can be riskier and there are more taxes. So it's not as easy to do as FIRE. That's what I'll say. Do not YOLO into any of these investments. The best defense that you have is your education and other people who have already done this. We will dive into the exact methods that you need in levels 5 and beyond on how to get into these cash flow investments. But for now, don't make any moves. Just be thinking ahead about cash flow and how you can generate it. All right, so now you have 2 models on how to reach financial independence. The next step is actually making them personal to you. We don't want you to think, well, someday I'll be free. We want you to actually know your real monthly income numbers that you need. For my example, when I was generating $6,642 a month in cash flow, this had a huge effect on our budget. So our base lifestyle was $6,000 a month. This has since gone higher with the baby, but this is where we were at the time. So our base lifestyle to cover all of our basic living expenses was actually covered from our cash flow, which feels crazy. And then our next tiers were $8,000 to kind of live our normal lives, and then $15,000 was complete freedom for us. So in this example from July of 2025, cash flow covered all of our base living expenses. I've since changed the naming of this a little bit. So let's jump into number 1, secure. So secure means that your cash flow covers your base expenses. So your housing, your food, your transportation, and your core bills and utilities, as well as your minimum debt payments. So this is kind of like the number to just barely keep your head above the water. Some people call this your survival number, but I think if you can actually cover all of your base expenses with your cash flow, That's freaking awesome because at this point, you are secure that if you lose your job or something happens, your cash flow will actually continue to pay your minimums. You don't need to generate huge amounts of cash flow to actually feel secure with it. So getting to this tier is a huge win. The second tier is when you are financially independent. This is where you still have your base expenses covered, but now you can pay a little bit more to aggressively pay off that debt, and you have your little luxuries like dining out and entertainment. So this is essentially what it feels like to live your normal lives today, where you're not skimping, but you're also not spending like crazy. At this point, you could leave your job and live a completely financially independent life. And then that third number is when you're completely financially free. So you have all those base expenses, you also have the little luxuries, and you have the big luxuries like vacations, international travel, and going to concerts. This is where you can live whatever life you want and truly not have to worry about your income anymore. So first, you're financially secure, then you're financially independent, and then you're financially free. And to chart these next to your investment portfolios, you can see that you're financially secure first, then you're financially independent, and then you're financially free. Whether you choose to do this through purely FIRE or purely cash flow or a mixture of both is up to you. But I will say that the lower your targets are to be financially secure, independent, and free, the easier they are to reach and then maintain. So we want to be really careful about something called lifestyle creep. To review this whole topic, remember that retirement is a number, not an age. You don't need to actually retire, but this is just when you're work optional and you don't need work to pay you your income anymore. And then you can quantify your cash flow goals as your freedom numbers. Remember, it's not about how big your portfolio is, it's about how much cash flow you're bringing in every month. So financially secure is when you've covered your basic living expenses. Financially independent, it means you've completely replaced your normal lifestyle expenses. And then you're financially free when you have absolute control over your time without any financial anxiety. Let's move into the takeaways and wrap this one up. So for FIRE, you retire by selling off 4% of your portfolio a year. For cash flow, that is passive income from your investments. And then freedom numbers, you're financially free when your monthly bills are paid by your cash flow. So whatever your method is, the goal is to convert your investment portfolio into cash flow that you can actually live off of it. And I have a couple of true or false questions here to work through. So first, true or false, retirement is when I turn 65. I hope all of you say false at this point. It has nothing to do with your age. It's when your investment portfolio replaces your income. Many people become financially independent and then they still choose to work. They're just now work optional. And that'd be a great way to go into your job knowing that you don't need it. Okay, next, I need 25K or 50K for my first cash flow investment. This is also false. There are stocks and ETFs, things on the public markets that you can buy with as little as $1. You can also choose to be active in the deal versus passive. So if you don't have the money to invest, you can raise money to get your own asset and use your own hustle. Next, growth and cash flow investing work together. This one is true. So if you have a longer time horizon, you can invest for growth, so it's more tax efficient, and then you can transfer to cash flow later, and that can help you come out ahead. You don't need to pursue just one or the other. And then let's get into the action items. So for FIRE, I want you to calculate your FIRE portfolio number, and then I also want you to do the same for your cash flow portfolio number. And then for your freedom numbers, I want you to calculate what those three numbers are so that you actually know when you hit your targets. So this is what we covered in this video. Now you know your exact financial freedom targets. And you have now completed level 2, Get Your Bearings, so you can stamp that field guide and then move on to the next level. Coming up, we have level 3, Pack for the Journey. This level is going to be super actionable for how you can lighten your load and accelerate your financial progress. The first video and number 3 is Grow the Gap, the system to maximize your investable income. I'll see you there.